What would you say if I told you that you could actually predict the future of stock prices just by looking at social media? A new group of investors are already employing the strategies that I'm about to share with you and are making millions of dollars in the process. The group that's responsible for these strategies is called Dumb Money. You can read more in the book Laughing at Wall Street by Chris Camillo. The strategy that they use to pick stocks is called social information arbitrage. Let's take a look at how it works and how you can use it to supercharge your investment returns. Before we start, be sure to hit the like button below if you want me to keep creating videos around new investment strategies. Social information arbitrage is a strategy for picking stocks that involves listening closely to what people are talking about on social media in search of potentially profitable investments. By this, I don't mean that you should tune into the latest financial guru and invest in everything that they tell you to. Instead, you should listen to what the masses are talking about on social media and do your best to uncover societal trends. Here's why this is a strategy worth considering. The main driver of stock prices is information. Investors need as much information as possible when they are evaluating a stock to make sure that they are making the right choice. They'll evaluate things like the company's revenue, price-to-earnings ratio, new management hires, etc. before making a decision. When new information is released about a company, investors become aware of it and will rush to buy or sell accordingly, which drives the stock price up or down. For example, if a company releases an earnings report that crushes what people were expecting, then investors will rush to buy the stock and its price will shoot up. On the other hand, if a company reports that they lost a ton of money, then investors will most likely rush to sell the stock and drive its price down. The problem with basing your investment decisions on information like this is that every other investor in the world has access to this same information as soon as it's released. How are you supposed to get above average returns by using the same information that everyone else has? Instead, you need to try your best to get information before it's released to the public. You can do this by identifying trends in real time that are likely to lead to significantly increased or decreased earnings for a company in the next couple of months. Things that people are rushing to buy today will result in increased earnings reports down the road, which will result in a higher stock price for that company. So, how can you go about identifying these trends? Well, there are 3 steps involved in social information arbitrage. We're going to take a look at these 3 steps in detail and then look at a real-life example. The first step is to identify a trend. This can be done by searching through social media or paying particularly close attention to what people around you are consuming. For example, most social media apps like Twitter, Instagram, and TikTok will have a trending tab where you can see what most users are talking about. There are also more sophisticated social listening tools that can collect this data and let you know quickly what people are talking about. However, these will usually charge you a monthly fee to use them. Another valuable tool that you can use to try and identify or confirm a trend is Google Trends. Google Trends is a very powerful tool that tells you what people are searching for on Google, the world's most powerful search engine. You can search for things that people are searching for in real time and can also view data as far back as a year. If you have a hunch that you think people are searching for a specific topic, this is a great way to double-check yourself and see if people are actually searching for this topic on Google. Keep in mind that searching for a potential societal trend doesn't need to take place exclusively on social media. Social information arbitrage can be done in the real world too by simply keeping an eye out for what your peers are talking about, buying, eating, or wearing. A few good questions to ask yourself when identifying a trend are: 1. What new fashion styles or trends do you see everywhere? Which brands are responsible for creating these looks? 2. What are some of the most popular books or movies that are coming out? Could any of these lead to increasing the sales of a company? 3. What are some posts that you see constantly being shared on social media? 4. What are some unpaid brand endorsements made by influential people? 5. What new types of food or drinks are people consuming? Once you feel that you found a trend, you can move on to step 2. The second step is to determine if this trend will result in significantly increased earnings for a company. The trend is only valuable if it will directly relate to higher profits for a publicly traded company. This is usually easy to determine if the trend in question involves a product. If it doesn't, then it might require a little more digging and critical thinking. The third step is to make your move. Ideally, you want to do as much research as possible so that you'll feel 100% confident in your stock trade. Once you reach a point where you've identified a trend and then confirmed that this trend will have a noticeable impact on the profits for a public company, then it's time to buy the stock. From here, it's totally up to you how much stock you want to buy. However, if you don't find sufficient data to back up your investment decision, then it's possible that you're simply grasping at straws and that this trend won't have a noticeable impact on a publicly traded company. Okay, that might have been a lot to digest, so let's take a look at a real-life example of how social information arbitrage works. The best way to start the social information arbitrage process is to come up with a hypothesis for why a stock's price might increase. From there, it's up to you to back up your hypothesis with as much data as you can. For example, let's flash back to the year 2020. During the year 2020, plenty of people had their lifestyles interrupted and were forced to live at a home for extended periods of time. Being forced to stay at home means that almost nobody is going to spend a lot of money on fancy going-out clothes and shoes. However, since everyone is spending so much more time in the house, it's likely that they'll want a comfy pair of house shoes to wear. For this, Crocs, the rubber clog company, are some of the comfiest house shoes that you can buy. A hypothetical hypothesis for March of 2020 might have gone something like this. Since everyone is stuck at home for the foreseeable future, they'll treat themselves to a comfy pair of Crocs to wear around the house. This surge in purchases for Crocs will have a noticeable impact on the profits of Crocs, which will likely skyrocket. By taking a quick look at Google Trends, we can see that the number of people searching for Crocs hit an all-time high in early April of 2020. This could have very easily been people who were visiting the website to buy a pair, because why else would you be searching the internet for Crocs? This is one piece of data that helps support our thesis. Other ways that we could have double-checked would be to search social media to see if people were talking about Crocs, visiting the Crocs website to see if they were sold out, visiting Crocs stores to see if they were flying off the shelves, or simply keeping an eye out to see if lots of people are wearing them. Now that it's 2021, we can take a look at Google Finance and see that Crocs profits most definitely increased during 2020. This is especially impressive because 2020 was a time when most retailers and apparel brands were struggling to sell their products. Let's see if this resulted in a spike in the price of Crocs stock. Yep, Crocs stock hit a low of about $10.70 in March of 2020, but a year and a half later, it's up over 1,000% to over $130 per share. Now, obviously, hindsight is 2020. It's easy to find a stock whose price has increased and search back for a reason as to why it increased. However, if you can identify companies that are selling tons of products in the here and now, then it will almost certainly result in a higher stock price for that company down the road. The trick is to identify a trend, make a hypothesis, find as much data as you can to support it, and then buy and hold their stock. If you can master this process, then you'll find that you're able to predict the future prices of stocks using nothing but social media and your own intuition. I hope that you found this video valuable in learning my secret formula to predict stock prices using social media. I plan to keep you updated on new updates on the best places to invest your money in an ever-changing world. If you're interested in learning new investing strategies and tips, please be sure to subscribe below and remember to hit the bell icon after you do. That way you'll be alerted every time that we post a new video. If you found this video valuable, please be sure to follow the very first link in the video description below and subscribe to my newsletter. By subscribing, you'll receive my most valuable tips for investing, any potential stock picks that I come across, and more informative content similar to what you've just watched. Most importantly, I don't believe in sending automated emails or spamming my subscribers. Instead, you can trust that each email that I send will be filled to the brim with valuable information that's sure to make you a better investor. Thank you so much for watching. I appreciate it, and we'll see you next time.